This is your technical update from the LMAX Exchange Research and Analytics Desk for Tuesday, March 15th, 2016. Euro dollar. So the euro is in a bit of a choppy mess at the moment with no clear short-term directional insight. At this point, we need to pay attention to 12.19 above. That's the recent high that we saw on the 10th of March. And below, it really comes down to 110 as a psychological barrier, which exposes 108.22 below there. So again, on a short-term basis, focus on 110 and 112.19 with a close below 110 to potentially put the pressure back on the downside towards 108.22, that recent low, or a break back above 112.19 and a daily close above 110.19 to expose a retest of the recent 1377 2016 peak. Sterling dollar. So cable looks to be carving out a lower top as this market gets confined to a broader downtrend, with the focus now on a retest of the recent 7-year low, which comes in at 38.36, going back to the 29th of February, below which exposes a measured move downside extension towards 135, which also coincides with the multi-year base from 2009. Dollar yen. So dollar yen has been locked in a bearish consolidation over the past several days, and the market is waiting for this next major break. At this point, given the downtrend, the consolidation is classified as bearish consolidation, and it would take a pushback above previous support around 116 to negate this outlook. Otherwise, the consolidation is expected to be broken to the downside, which eventually exposes a retest and break below the recent multi-month low at 110.98, opening a measured move downside extension towards the 107-108 area further down. Again, a break back above 116 would be required to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss continues to trade within a recovery structure, and the market favors putting in a higher low somewhere above 107 in favor of the next major upside extension beyond the multi-month high at 112 and towards 115 further up. Ultimately, any setback should be very well supported, with only a break back below the multi-week range low at 107.15 to compromise this constructive outlook. Aussie dollar. So Aussie has recently traded up to fresh 2016 highs, just shy of 76 ahead of this latest minor pullback. But overall, this latest upside break does suggest that the market could be poised for additional upside beyond the recent high that we saw at 75.94 and towards the 78.49 high going back to June of 2015. At this point, it would take a break and close back below previous resistance turn support at 73.85 to take the immediate pressure off the top side. Dollar CAD. So dollar CAD is finding some really good support by the 78.6 fib retracement off of the October low to January high move, which comes in at 132.30. We did see a bit of a break below that level on last Friday, with the market trading down to as low as 31.68. But again, the market has found some support and is now looking to recover. At this point, though, it would take a break back above the recent high that we saw on the 9th of March at 134.47 to officially take the pressure off the downside and suggest that the market is bottoming out in favor of a higher low. Until then, there is risk for another lower top and downside extension below this recent low at 31.68 and towards a full retracement to that October base at 128.32 further down. Kiwi dollar. So Kiwi continues to show signs of being very well capped into rallies, with the market once again stalling out ahead of the critical medium-term resistance at 69, stalling out at 68.20, and reversing lower to put the pressure back on recent support at 65.46. A break below 65.46, which is the low from the 16th of February, would accelerate declines and expose more critical support in the form of the low that we saw back on the 20th of January, which is at 63.47. That's also the low for 2016. SPX 500. So the S&P 500 has rallied back into an ideal lower top zone, with this rally classified as a corrective rally over the past several weeks in favor of a lower top and resumption of declines, eventually back down towards that 1808 recent multi-month low, below which exposes the next major drop towards a measured move at 1600 further down. At this point, only a close back above 2050 would compromise the bearish outlook, the newly adopted bearish outlook for the S&P 500. Gold. So although we've seen some setbacks in recent trade, gold is expected to be very well supported on dips towards the previous resistance now turned support at 1192, 1191. At this point, only a close back below 1191 would compromise this outlook, while inability to do so will suggest that the market is consolidating ahead of the next major upside extension towards and eventually above the 2015 high from January of 2015 at 1307.